Hi again, welcome back. In this video, we'll begin the discussion of the present value of annuities. Here's an example. Rita wants to accumulate a sum of money for graduate school. She wants to invest a single amount today in a savings account, earning 10% interest compounded annually, and that amount that she wants to invest would be equivalent to investing $10,000 at the end of each of the next 3 years. The hypothetical payments were to be invested at the end of each of the next 3 years, making this a present value of an ordinary annuity problem, where n equals 3, I equals 10%, and the annuity amount or payments are $10,000. So let's look at Table 4. That's Table 2. Flip to Table 4. Present value of an ordinary annuity. Run down the left column to 3 and follow it over till you find 10%. And you get a factor of 2.48685. Multiply that factor times $10,000 and you get $24,868 rounded. Slide's going to do it the long way for you, coming up still with the same number we just got looking at the tables, 24,868. And then the slides will show you the same way that we just did it, using the present value of an annuity table. What would be the present value in the previous problem if the 3 equal payments are to be made at the beginning of each of the 3 years? That would make it a present value of an annuity due problem. Turn to Table 6, present value of an annuity due. Four, 5, 6, Table 6, present value of an annuity due. N equals 3, I equals 10%. And you get a factor of 2.73554. Multiply that factor times $10,000 and you get $27,355 rounded. They'll do it the long way first. 27,355, then they'll do it the way we just did it by looking at the present value of an annuity due, PVAD, table, and coming up with a factor times the annuity amount of $10,000. Beginning on page 253 of your textbook, the text begins to discuss a deferred annuity. A deferred annuity exists when the first cash flow occurs more than one period after the agreement begins. Example, at January 1st, 2021, you are considering acquiring an investment that will provide 3 equal payments of $10,000 each, to be received by you at the end of 3 consecutive years. However, the first payment is not expected for another 2 years until December 31st, 2023. Your expected return is 10%. You're not going to make this investment unless you can get at least 10%. By the way, nothing's paying 10%, but for the example, you want 10% return. How much would you be willing to pay for this investment? Let's figure out the information we do have and the information we don't have First of all, we don't know what the present value is. We do know that I equals 10%, and we also know that there are two separate periods. There's the N equals 3 for the annuity calculation in this problem, and there's N equals 2 for the present value calculation in this problem. So this problem should be viewed as two separate present values combined together. First, you need to find the present value of an ordinary annuity where N equals 3 and I equals 10%. And once you calculate that number, then you need to find the present value of that number for 2 years at 10%. Just the regular present value, not an annuity calculation, just the regular present value calculation. Step 1. Look at Table 4, present value of an ordinary annuity where N equals 3 and I equals 10%. Table 4, present value of an ordinary annuity, N equals 3, I equals 10%. You get a factor of 2.48685. Multiply that factor times an annuity amount of $10,000 and you get $24,868. What that means is the present value of this annuity is $24,868, and if the investment began, the 3 annuity payments began at the end of this first year, then that would be the amount we'd be willing to invest for a 10% return. But the payments don't begin for 2 more years. So what we need to do is find the present value of this amount, the single amount, where N equals 2 and I equals 10. So go to your present value tables and find the factor. I did not mean to do that. Let me go back up. This is what the factor is going to be. The present value table is table 2. Present value of a single amount where N equals 2 and I equals 10%. The factor is 0.82645. Multiply that times the present value of the annuity, and you have the value today of $20,552. Therefore, if we expect at least a 10% return, the maximum amount we would be willing to invest today is $20,552. Here's a problem for you. Please pause your video and consider the following question. Once you have selected your answer, start the video again to check your work. Harry Bird's Chicken Shack agrees to pay an employee $50,000 a year for 6 years, beginning 2 years from today, and decides to fund the payments by depositing one lump sum in a savings account today. The company should use which present value concept to determine the required deposit? Is it the future value of 1? Is it the future value of a deferred annuity? Is it the present value of a deferred annuity? Or is it none of these? I think probably all of you chose number C, present value of a deferred annuity. Well, that's all for this video. In the next video, we'll work on determining the annuity amount when other variables are not known. See you next time.